Hi, this is Jeffrey Cohen. How are you guys today? It's Friday, April 9th. It's week 14 of 2021. And I have a lot to talk about today. I'm going to spend more time about the business because there's updates, but wow, do I have a lot of tabs open and a lot of data that we can walk through. So I guess the big news of the week is that the stock market keeps rising and we're looking at pretty much historic highs. And it's historic highs. It's never happened before, right? They're up. The market keeps going up. What's going on? Well, there's great data, very good economic data, and we could talk a lot about it. I know I shared a lot last week, and there's been nothing to really stop that narrative other than COVID, the pandemic. And in the US, I think I read we're up to maybe 20% fully vaccinated. Maybe 35 to 40% have gotten one shot. And so the US looks like it's going to be coming out of this malaise that we've been suffering economically, while the rest of the world might take a little bit longer. Kind of great to be in the US. One of the things in this headline from Bloomberg, right? Bonds smell Fed trouble. So there's a question here about when will the U.S. Federal Reserve do something? When will they tighten? When will they taper? When will they stop injecting liquidity in the system by buying paper? And when will they start to maybe pull liquidity out of the market by selling paper? You sell the paper, you take the cash, right? And so, not sure, but one of the things I noticed was, we talked a lot last week before, about yields. Let's see if I can find this. So, we're going to go to FINRA, Bond Search, right? FINRA, by the way, awesome site. I know I talked about it last week. You can go right to FINRA, you can go right to the 10-year, and you can see that for the 10-year, you're under 1.7. You're at 1.64% rate or yield on 10-year money. That's down. We were worried. This thing had hit 1.7. It was heading towards 1.8. I mean, we were looking at maybe 2 or 3 point 10-year money, 2% 10-year money, and in fact, it's dropped back. And the short-term money, 13-week, is under 1/10. I think it's 0.8%. It's 8% of 1%. It's crazy. There's no yield, and so what we're looking at, and it's a nice steep yield curve. So that's what we got now. I could show you what's going on with my favorite stock, which is Summit Midstream Limited. I'll tell you not much, right? So it's kind of cool to learn how to read about all the bonds, though. So these are trading at a percentage of 100. So 64.02 means it's 64% of par value for the bonds, for the preferreds. And 82.428 is about 83% on corporate bonds in 2025, and 96.35. Other thing that's interesting, right, so you can take a look, is you can learn about trade history and how often things are trading. And so you can see here, traded on the 6th, traded on the 5th, traded on the 1st, and these are dollar amounts, so par value of the trade is $173,000 of bonds. At 64 points is maybe $120,000. And so it's good to follow up. Why I bring this up to you, though, is you can actually see market activity on bonds. So this is today. I looked at it yesterday as well. I've been looking at it all week. And so you could see advances versus declines. And you see it for investment grade doing great, right? Investment grade money. People want to be in it. High yield, you also see more advances than declines. And the dollar value, surprisingly, if we're looking at it looks like $20 billion of debt that traded, maybe it was 6 or 7 that traded on high yield. And so lots of high yield. And the other thing that I noticed, I don't know that you're going to be able to find it here, but just suffice to say, the high yield debt market, the high yield market is doing great for issuers. So if you're a high yield issuer, like a Summit Midstream Limited or just recently NGL, you wanna be issuing debt and getting yourself ready for post pandemic, getting yourself ready for the big recovery that you're expecting. And so it's just interesting, right? Strengthen the bond market, and you're going to see this cascading into the discussion because you see a strong bond market. You're also going to see a strong stock market. So let's talk about that as well. And I just want to bring this up because Summit, right? This is a debt that they don't ever have to pay back. This is preferred stock, subordinated and unsecured, with a Standard & Poor rating of a C. It's a pretty low rating. It's junk, right? And his junk is supposed to pay 9.5%, and they stopped paying it. They've deferred. So they're accruing the money. They're hanging on to it. They eventually, if they want to ever pay a distribution, have to pay it. But for right now, they're not paying it. And so been a while since they've been paying it. And it's yielding 15%, 14.8. So you can buy it, and if they do get things cleaned up and they do want to pay out an equity distribution, you're going to be earning a handsome yield, and also approximately $170 in deferred. So let's say you buy it at $640. You're already looking at $170, and then you go from there. It's going to pay $95 a year. That's actually a pretty good deal if you believe that they're going to be able to get their house in order, drive up their earnings, and pay off their debt. And so, personally, I believe they will. We don't own the preferred, but it's a good way to think about it. But across the market, you're seeing this story play out. If you're a high yield issuer, if you've had a tough year, the market right now is forgiving. There's money out there chasing yields. So, good time to borrow. In case you're listening out there, SMLP. Good time to get your May 2022's maturities in order. I'm sure you're not listening. So the other thing I wanted to talk about is a Meltup. God, I hate that term, by the way. Let me get rid of this. A Meltup is when the market just goes up and there's no one knows, right? It's like nobody even knows why, right? It's just going up, melting up. And so, and I don't even know if I believe this, but I guess I should, right? Equity funds have attracted $500 billion in the past 5 months. So that's $100 billion in fresh new money going into equities, probably passive, per month. So $100 billion a month. That's a lot. That's enough to really drive up asset prices. It's great, right? So if you're in the game and you've got money invested and there's another $100 billion coming behind you, that really makes a big difference. And I love it. I love it because I'm long, right? So I love it when new people put money in. And you see the VIX. The VIX is volatility index, right? It's like they call it a fear index. When that number hits like 25, 30, you get nervous, very nervous, because it means you have to kind of pay a lot of money to bet against market volatility. Here it's at 17 points, which is the lowest level that I've seen since I started making these videos and a year before. So, somebody making bets, right? YOLO, you only live once. Let's bet on the market crashing. I think it's great, right? People, as long as there's some worry out there, I feel a little better about the market. When everyone's effervescent, then I'm worried. So, just a lot going on, right? You should be worried about valuations. We're risk on. but who knows? And so I just want to point it out. This could be part of the stimulus, by the way. So 576 billion has flown in, but our stimulus is over $1 trillion. And every time we do stimulus, a lot of that goes into savings. Now, some people spend the money, which is terrific. That money then gets saved by the person they spend it with. And so you have a lot of money, a lot of liquidity flushed into the system, and it's moving into equity funds. And so I don't see a top. If anything, I just see continued highs. And so I see nothing that stops this market. I love when I see huge amounts of cash, 100 billion a month coming in, because that just means more money coming in. So let's start taking a look. I'm going to show you guys my new server, but not right now. We bought some new tech, by the way. Maybe I will. I'll tell you. Bought a new workstation. Bought a Dell 5820, and I've spent almost as much on upgrades to the Dell than I have to the actual server. It's got a very new Intel Xeon processor, fast, new, lots of great throughput. We're going to be quadruple the memory of the server that's over there. And the memory is almost twice as fast. So I love it. I just set it up today, and wow, that thing screamed fast. And so I can't wait. This weekend we're running a job. I might actually get to run it on the new server. So we'll see how we do it. So this is one of the things I want to talk about, right? New server. So now we have a new MacBook Pro. We have a new server. I'm in discussions right now with ICE about buying data. Once we talk to ICE and we get that squared away, which will be for NASDAQ, then we'll talk to NYSE. The idea is to have a backup plan, to have maybe access to some new data, especially bond data, maybe some futures. I mean, right now we work on equities, but it'd be interesting to see if we had more data, what we can do. So new server. I want to thank if our clients out there, I want to thank you for being a good client, and that money is going right back into our business. And whether it's equipment, whether it's data, whether it's time, it's good. And so I'm going to talk a little bit about some of the things that we've done, and just for the spirit of typing them up so you can follow. I'll talk and I'll type. Let's get it out there. Share what we can. So we have a long and short models, right? And what I'm finding is that the long model does okay, right? The markets are at a peak, so you would expect them to do okay. The short model's doing amazingly well. It's identifying highly volatile but slow moving stocks. Noise without purpose. And usually that ties into things like meme stocks or pump and dump stocks. So imagine being able to identify those early, very early. You can start to take action. So these stocks tend to move as individuals, which is a different model. It's a different activity profile. So just, it's good to know, right? We've got that. So the second thing I want to talk about is we deepened and improved our Monte Carlo and solvers. And we did that this week. See, what was happening is we run, we make the server tired, and the answer takes a very long time. Well, now we have a faster new server. And we improved 2 of our solvers. That's good news. That's good news for our clients. That's good news for us. We've got another client that's looking at like virtual reality stuff and media stuff. So imagine if they want to get solutions, we're going to be faster, better and faster. And just any new client, if you've got a problem you want to solve, we're in conversations with another one through a statement of work process. And it's just great to have this. It's great to be able to like rip through analyses and find great solutions very, very fast. We're also doing work on eigensolvers. Our team just, actually Clark Alexander just published a paper on random walks on graphs, and there's just good work going on. Lots of things going on. I guess we could talk about new data providers being we're looking at contracting for data. One of the things we had thought was that we would partner with a large firm and we could use the large firm's data, but at this point that hasn't happened, and so we're just going to become a large firm ourselves, which is fine. And I guess that's about it. I guess in terms of the market, I just want to say is that we are longer on SMLP, Summit Midstream Limited. Bought more pretty much every week as it declines for around 20 days in a row. Ugh, that's really hard. It's really hard to, it takes real courage. And lots of homework. We initiated a position in NGL, which is at their bottom. These are both midstream oil and gas. So it's a little bit more to cover in terms of our model and running. I think there's something else I can talk about. We are getting more cozy, familiar, experienced with beta, with our Chicago Quantum Net Score, and dividend yields on our stocks. If anyone wants to look at market performance and how it differs in up and down markets, call us. Now, obviously, you could say, well, Jeff, in a down market, stocks go down. And in an up market, stocks go up. I think that's terrific. But there's a lot more to it than that. And so I think there's a chance that the profile of the movements are different. And so, let's talk about it. We're working on it. We continue to work on it slowly because we're running, right? So week 14. So I'm going to go through some other I'm going to go through some more data. I love sharing data with you guys. Forces me to stay up on things. So let's see. Make sure you can see this nice. That's not what I want. All right, let's take a look. 1 week performance. Wow, look at that. Amazon's up. Google, Facebook, Microsoft, Apple, your financial service, credit, insurance, banks. So basically you're looking at tech. You're looking at the fast flyers, whether it's Tesla, whether it's Home Depot. They're doing great. You're seeing a recovery in stores, consumer defensives. People think the market's going back up again. Specialty industrials are up. Diagnostics are up in healthcare. Devices are up. Look at the whole financial services space for the most part is up. You know, the only place that really isn't up is healthcare. Right? Healthcare is struggling right now, and energy. Energy is struggling quite a bit. Look at Occidental. Hate to see that. You know, Occidental's in the Permian Basin, and I was going to do a quick note about the Permian Basin, just to talk about it. But net, so when you're long energy, when you kind of love energy, and you're thinking about pipelines and exploration, and you're thinking about end products, and the market doesn't do well, you know, you get sad. Just imagine if you were in the healthcare business and you're just focused on healthcare, you really struggle. So just wanted to share this. You know, we like to look at the world. Oh, so by the way, net, this is why the market's going up. People are pumping money into the tech stocks, right? Into NASDAQ, it's going up. If you look at the world's pretty green with a few exceptions, right? Brazil's struggling right now. I don't know why. Could be they're having a lot of trouble with the pandemic. It could be pandemic related. Japan is down, is mixed to down. It's a bit of a struggle. Oh, yeah, something's going on in Israel. Oh, pharmaceutical, Teva. Maybe that's what's driving it. But South Africa looks good. Australia looks good, which means minerals mining. Taiwan's looking very strong. Singapore. You know, China, mixed bag. I'm sorry to say. So, mixed bag in China. So, in general, markets up. You got some weakness in energy. You got weakness in healthcare. Look, Takeda. And that's the story. And you got weakness in Brazil. So, there's your markets. Let's take a look at some of the indexes I like to follow. So, S&P 500 over 5 days is up. But we know that. But what's interesting is it's up like all-time high up. It's acceleratingly up. Look at that curve. Just for those who maybe don't see so well. Look at that curve. Since April. It was 2,200. It's like 4,100. It's crazy. I mean, if I draw a line to show you how much it's gone up. Even if I don't do it right from the bottom, even if I just take it like this, let's see if we can do this. All I gotta say is the market's really up. S&P 500 is up. It's up like crazy. If we look at the NASDAQ is up. I mean, it struggled a little bit earlier this week, but there's your tech. Your tech is driving this thing much higher. Now, the Russell's interesting. The Russell, because it's more Main Street, Russell struggles, right? It's a lot harder to put money into small caps because you can't really get it out. These are long-term plays. These are either super risky or longer-term or more committed plays, right? You buy Apple, you sell Apple. You buy Microsoft, you can sell Microsoft. These are highly liquid. If you don't care, you're at the top. You're in and out of these things like nothing. But you look at the small caps, and you've got to have that commitment. And so what I would say for small cap is from November really to early February, you saw a strong commit. It's been flat ever since, right? So the market is starting to hesitate pumping money into the small cap stocks. Now, we haven't hesitated. We're fine. We're feeling pretty good about it. But wow, what a struggle. And wow, what a struggle. Look at SMLP. This thing is a dog with fleas, and I'm an owner. I'm sorry my dog has fleas. Look at this thing. It's awful. It's just awful. All right, crude oil. Well, maybe oil and gas is down because crude is down, but actually, 59 and a half, 59.42, you're fine. Over 5 days, over a month even. Let's take a look. It's been 65, but if we look over the year, it's risen and it's pretty flat. So in my mind, there's a whole kind of narrative around pandemic recovery, economic recovery. We're seeing a strong economy. We're seeing it start to lift, but we're not really seeing it soar. It's lifting, but not soaring. And so maybe there's a lack of commitment long term. But then we take a look at something like the euro. The euro is at $1.19. I remember this thing was $1.16 not that long ago. Let's see if I can see it. Yeah, it was 117. But
it's 13 hours.
Put this thing over a year. So at $1.19, it means the dollar is starting to recover. I'm sorry, the dollar's starting to fall. The euro is starting to recover. And so there was a lot of concern. Money flows to the U.S., reserve currency. People are nervous. Our rates are going up, right? 10-year money was going up. And people were saying it was going to hit 2%. And so the dollar gets stronger. But now what you see is the dollar's weakening. I saw this all week. Again, it changes the narrative, right? Dollar's weakening. What else we got going on? Treasury yield. Of course, towards the end of the day here, it starts to pop up a little bit. But the yields are down. 1.65, you could be looking at 1.5 point 10-year money right now if the trend continues, right? It's gone up. People were scared that this was going to just keep going, but actually it's come down this week. So there's a little less fear, right? Rates come down. People are less nervous. Hey, put some money in tech when rates come down. Natural gas, we'll also take a look at oil. Natural gas is holding its own. 253. By the way, the Henry Hub is a little bit higher than this. So, natural gas is okay. It's had a pretty good week, which is good for natural gas companies. One of the things we haven't talked about is 13-week money. One of the things that's important is if you take a look at truly short money, 13-week treasury bills, and you look before the pandemic, you look for the full year and a half before, you saw it was like 1.9, went up to 2, 2.5, 2.4. We're not talking about basis points. We're talking about like 2.5% money, 2% money for 13 weeks. You could park your money. I remember I had a Goldman Sachs account. I was earning 2.5%. I thought the world was a beautiful place, right? I'm making all this money. So take a look what happened, right? So after the pandemic, short money dropped. Short money dropped to 0.1 to negative. At one point, short money was negative. You had to pay the government to have them hold the money for you. And now this thing is asymptotically moving to zero. This line right here is zero. See if I can draw that line for you. Make it nice. There it is. There it is. Right there. Flatten it up. So that line right there is zero money. And you can see we've been trending to zero. So that's crazy. We're actually pretty much at zero right now. We're at 0.003. Nah, I don't understand. I gotta tell you. It's kind of crazy. So short money, there's no place to put it. You might as well stick it in a dividend yielding stock if you think it's going to stay. That's, I think, what people are doing. So you take a look at the dollar against the renminbi, right? It's also one. It's not much though. It's not much movement here. The Chinese are pretty good about keeping their money stable. But you see a decline. So you flip it. So if it's 6.15. It's like 6.5 renminbi per dollar. And I remember last time I was in China, it was like 6.4, 6.35. So it's been consistent for years. Volatility index, right, through the floor. So if we take a look at that over the past year, it spiked to 40 when the market was dropping with the pandemic. And you've had some spikes at 36 in June. You had some fear in October, which then settled out in November. You had a little scary time in January, one in late February, but now there's no fear at all. There's no volatility at all. And so the way you look at this is, if there's no fear, if there's no volatility, if the market's melting up, gently rising on the backs of $100 billion a month in new liquidity, just into equity funds, and then there's other money that's going into bonds, which also could rise up some of the equities, and then you got more lending, you got lower cost lending, so you got companies borrowing, which allows them to keep making investments and to keep spending, and so volatility's down. I wouldn't expect to see this if I saw people being nervous. They're not nervous. Maybe the smart money should be nervous, but for right now, I'm not seeing much. The FTSE, how's Europe doing? We look at it over a month. Man, that thing's climbing like crazy. Look at the FTSE up there. It's like we're playing FTSE. So UK equities up for the week. I told you they were up. The DAX, German equities rose early in the week. Yeah, a little bit down, a little flat. So, German stocks flat, up early in the week and then flat. We look at French stocks, up. We look at Japanese stocks, mixed to down. Let's look at it over a month. Good recovery from mid-March, and that trend is continuing, but actually it dropped. So something must have happened in March. Maybe the spring blossoms are coming. People aren't so interested. You get the Hang Seng. We had some weakness there, but it looks like it's clawing back, trying to make a little bit of a recovery. It looks like Thursday afternoon, market was looking up. Just on and on, right? Too many charts. All right. Some of the things we looked at last week maybe bear more mention, right? Personal income was down, so the market, the economic activity looks good. The housing stock is compressed, so there's not enough houses, but there's not a lot of personal income, and actually with interest rates dropping, people are not making as much money on their money. We're still looking at a huge federal deficit. We're looking at a trade deficit. I know I talked a lot about that. Yeah, what I would say here, I'm gonna stop talking about a lot of economic statistics and just talk right to you in the microphone here. So, what I would say is this. So, as we run our models, we're seeing different stocks take leadership positions in our long model. We're seeing different kinds of stocks. So if you had bought our model run 3 months ago, 2 months ago, you're seeing different stocks. And so different stocks are making the move. We're also just at that 1 year point past the pandemic. So the market right now that we're analyzing, that we're living in, it feels like it only goes up. And as a reminder, markets go up and they go down. Stocks go up and they go down, and that's just the way it is. From a short perspective, our model is finding stocks that are either subject to market manipulation, pump and dump, lots of attention, and a social media type attention. And so you have stocks that are moving without direction. And there's a chance, if you're a trader, that you can make a lot of money by going long, going short, just seeing a ton of volatility, lots of swing trading type of activity going on. And from us, clients are welcome. We're busy, and Chicago Quantum is here to work and give us a call. So I want to thank you very much, and hope you have a great weekend. And we'll be back at you next week. You take care now. Bye bye.